After a weekend that was pretty much spent with Bitcoin down, 2 to 3% for most of the weekend, leading to some expectation of at least an opening gap to the downside for the for equities in general because of their link to risk appetite. Boy, did we ever get one of those. So we were down pretty significantly at the open, and after a dead cat bounce earlier, kind of late morning, we sure finished the day down towards the lows. Very significant low drops today, very significant break. So we're going to talk about that from a technical standpoint. In my mailing list, in our email mailing list that you're sending out, I'm sending you a link of a discussion I had in a Q&A session on Saturday for all of our premium subscribers. Just a segment of that Q&A session where I talked about my bear market expectation. I don't believe we're in a bear market yet. I do believe that we're probably headed towards one. And in that segment, I'm going to break down my timelines and targets of that. So make sure that you subscribe on our site to our mailing list so that you'll be able to get that link in tonight's email. Let's go ahead and get started. Today is Monday, June the 13th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started here, I invite you to subscribe to our YouTube channel, hit that thumbs up icon, like our video down below, comment on the video. Also join our website at MarketScholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out these things over here down below. Click on this heart icon. It opens up this tab. Hit that like button. Also click that thumbs up icon. It opens up this tab. Hit that like button as well. Again, the more you do that, it really helps us get our content out to all of our followers. So we really appreciate those of you who do like our content for us. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. As you can see, 3 consecutive down declines. In fact, I've heard some references on this. We had 3 consecutive down days, 90% or more down days, I believe, on the NASDAQ for the first time since August the 24th of 2015. So I'm going to kind of zoom out here so we can see a comparative day to what we're seeing right now, a comparative period. We've had 3 down days in a row, 1, 2, 3. The 24th coming after an expiration Friday. Really down days going into it, and then the last down day coming out of it. We were down pretty sharply that particular day. So if you notice here on that day, on that third day, the intermediate line finished just outside of the reversal zone. We ended up with the cluster the next day on the 4th day, but we finished just outside the reversal zone. You can see we were 9% below the 30-day moving average on that third day. So compare that to now, and we are 7% below, which is not lower. See, that was lower on that particular day. That was lower than any other period we had seen. We had not broken 2.5% until that 3-day period. We've had broken 2.5% multiple times. We are only 7.25% down now, which is not the lowest point. Not even close. Remember, that was by far the lowest point before. And then also, too, the intermediate line, remember, was just above 21. We ended up with the cluster the next day. We're just dropping into bearish territory today. This is the first day we're actually in bearish territory. So that kind of shows that this is not quite the same kind of drop that we saw the last time we've had 3 consecutive down days. And you can kind of see here on this chart, to get these 3 down days of more than 2%, I mean, you have to go back. It's pretty far to get 3 consecutive down days of 2% or more. I mean, look, you can see this in this current period, we never had even 2 in a row, and we've had 3 in a row. If I were to come out here to the COVID drop, we had 2 in a row, but we never had 3 in a row. Of 2 consecutive down of 2% or more. You come over here to 2018, we had 2 in a row. We had quite a big session of 1 in a row at 1% or more declines. But we've had multiple 2 days in a row, even in the first quarter of 2018. Zoom out over here to the 15-16 period. There's your 3 consecutive 2%, and one of them being well more than 3 down to 4. So it kind of built up to 2, 3, and then 4. In this particular one, it was 2, a little bit more than 2, almost 3, and almost 4. So very similar period, but different in that regard. And if you go back to that 15 and 16 as well, we did gap down pretty sharply on that third day. We gapped down 5% that day. So we actually rallied intraday on that day. That wasn't the case here. We've only gapped down 2%, 2.5%. It's a pretty significant gap down and finished down lower. Kind of get a little bit of a dead cat bounce. And you can also see too, going back out to that 15-16 period, 2015, the spike in volatility was well above historical, well above. That's not the case right now. Right now you notice that historical and implied are sitting right on top of each other. You can see over here the numbers. So if I go back, you can see, go back to those numbers. They're sitting right on top of each other at 31, 32%. So a very different day, even though it is the first time since then that we've had 3 straight 2% down days or more, one of them being more than 3, in this case at least one of them being more than 3, 2 of them back then in August. But you can see it's not quite the same day. We're just not, today is not the capitulation. Today could very well, these 3 days could very well be the beginning of a capitulative move, but today is not the capitulation, according to what we see here on the charts, and for that matter as well in the market forecast. We're not anywhere close to a cluster, which is typically what either get a cluster or a long lower shadow on a capitulation day, and that's not the case. This is a pretty significant breakdown though. If you notice, we did break down below the low point of that long lower shadow on May 20th. That low point acts as a support level. That support broke today for the first time. We also broke below these 2 important lines, the 23 and 38% lines that we've been watching for so long that the NASDAQ and Russell have already broken below. Well, now we're breaking below it on the S&P. So, and significantly, this is hardly like a little bit of a dip. We could come back up tomorrow by 1.5% or more and still not get back above those lines. So that's how significant we are below that. Very, very significant breakdown on the S&P 500. When you look at the NASDAQ, you remember we had already broken below that 23% level. Well, if I were to go out to the, let's just go to a 2-year chart. If I were to zoom out, there's your 38% level. That's how close we are. See that gap between the 23 and 38, we're mostly filling in on the NASDAQ, and we're just barely breaking it. Like we're at this stage on the S&P from over here. And when you look at the Russell 2000, which looks very similar, extremely oversold, the intermediate line dropping 6% below, we have already broken below that 38 and 23% lines, and then there's where your 38% line is. So we're almost touching that one too, as well as breaking the 50% level of the post-COVID rally. That's what you see there. That dotted line is the 50% that we have broken on the NASDAQ. So we've lost more than half of the post-COVID gains. The S&P, that would be down to 3,500. And of course, that's a really important level for the S&P 500 because that is where the 200-week moving average is. So remember, the NASDAQ's broken that dotted line, and I believe that the S&P ultimately will too, and work its way down towards this 38%, 62% retracement level. By the time this correction is done, that happens to be where the 200-week is. For the NASDAQ, I think that's where we're headed there too. And then if you notice on IWM, it's down into this area, so down towards 155. So we are already below the 200-week moving average in IWM, and we are just now getting there on the Qs. The other thing too that kind of stands out, so let me come back over here to the 3 green arrow chart here. You can see we just started 3 red arrows, excuse me. If I were to zoom out again on this one to that August of 2000, there's the third day, right? The third day right there. There's your third day, and we had just gotten it too. But look how deep that MACD histogram was down there. This is a let's see. Let's do the PPO of this. So let's go to 10 years so we can normalize that MACD histogram as well. So here's where the histogram is now. The MACD is at 1.14. The histogram is at 1.24. That's where we are now. If I were to zoom out and go back to that 15-16 time frame, where we had also just gotten 3 red arrows just relatively recently right here. Remember, we're at 1.14 on the MACD. On that day, we were at 1.64. And then you can see the histogram was at 1.28, and we're at 1.24 now. So similar, but not to the same extent of how, and you can see just how far below the 200-day moving average we were then. We had just broken it. We are already well below it now. So again, a little bit of a difference here. And look at the gaps that we've been getting, and the increase in volume up to at least 1.5 times the average volume there on the S&P 500. So let's go to the weekly chart, and you can see we're back to a weekly candle, very significant weekly Hakinyasha candle after multiple transitions. The PPO is falling. It's very significant. This is the biggest weekly decline, the most bearish candle that we've had since COVID, right? So more bearish than the candle we had in 2018, and more bearish than that candle that we're alluding to right now in 15. So a very bearish candle that we haven't seen since COVID and since the end of the bear market. Even the beginning of the bear market, is bigger now than we were there. So very significant candle size, and again, just turning into that. We just barely had transitions. As usually you kind of end a trend with something like that, and we're just rolling over here. You can also see too, that whole moving average is something we've been paying attention to. So there's your red line, there's your parabolic stars, there's your significantly bearish Hakinyasha candle, and then how far away we are from the 200-day hull is very low, like almost 10%. And again, let me zoom out there to kind of give you an idea too of what that looked like in 15. In 15, we were 11% below. Well, on the actual day, we were 10% below. So the whole. So you can kind of see these double-digit numbers tend to be a limit for how far below the 200-day hull, unless we are in COVID, right, where we're just going parabolic down to the downside. So when you look at now, let's take a look at the Arun indicators. What I want to look at too. And the McClellan oscillators. The Arun indicator, we did get a new 4-week low point because we broke that May, so we got a new break up to 100 on the negative indicator on the S&P 500, and that will we don't typically turn around a bottom until the positive. Once we get that break on the negative to the upside, then we have to wait for the positive to get to 0, and the positive's still in the upper half of the chart. So the positive's got a ways to go before it gets to 0. So we'll probably be coming down here for a while. I've been mentioning that when we had that breakdown there, that this was probably the start of the capitulation drop that everybody thought this one was, and some people, Kramer thought this one was. Kramer thought the quote-unquote bear market ended here on that rally. Of course, it's kind of hard to call a pullback a bear market, but that's what he did, and they thought the capitulation move was there. A lot more people thought it was here, and then of course now it appears to be we're starting that capitulation move. Let's look at some of these other oscillators. The RSI breaking, the CCI breaking below -200, the RSI well below 40 in bearish mode. The DMI breaking out, getting above 40 in the positive. You can see it's not very common to get above 40. Again, going back to the 15-16 time frame here, you can see, you can see that on that third day, the positive DMI got up to 66. We're at 40 today. The negative got down to 9.8, so below 10. We're at 13.8 today. So again, much different response, but you can see ultimately what happened. And I think we're headed towards a move where we'll spike up here, and then positive will spike down, and then we'll just kind of stay down. Because that's the thing with the VIX right now. The VIX is spiked up to 34, but it just barely got to 100. It's not up to 125%. Again, going back out to that same time frame of 2015-16, on that same day, the VIX also jumped up pretty sharply. It got all the way up to 40 on that day. We're only at 34. But you notice the VIX ratio on that day got up to 130%. We're not even at 100% today. We're at 99%, which means the VIX 3M, again, the VIX 3M here finished that day at 31. The VIX 3, as bearish as that day was, the VIX 3M closed higher today by about 10% than it closed on that day, as capitulative as that day was. So what that tells us is we're still not done capitulating because the VIX isn't high enough. It needs to be higher than this, to 115, 125% higher than VIX 3M. But the fact that VIX 3M is still this high and staying this high means that once we do capitulate, which will be sooner rather than later, probably within a few weeks or a month, we're not looking for a V bottom type move. We're looking for, well, once we hit that hard low, we'll go up and down and stay near these lows for a while. At least that's what the VIX 3M is telling us over the next 30 days, that we'll end up just staying low by the time we finish with this 3-month period. Because remember, it's not over with. This run-up's not over with either. Let's take a look at those gaps today, and you can see the dead cat bounce where we gapped down, we made a run back up to the bottom of the gap, and then held for resistance and rolled over. There's that 38% retracement level, the market sentiment line, or that the post-COVID rally, that we talked about. So there's a significant drop there. You can see the gaps. We filled in all these other gaps that we talked about that eventually would fill in. You can see how easy it would be eventually to fill this one in. And we talked about this having before we talked about this having the characteristics of a runaway gap. It looks like now it is a runaway gap. And this very well could be a successive runaway gap too. So, at some point in time, you would expect them to get filled in. I just wouldn't expect it to be anytime soon. You can see we are well below Friday's low point, which was also last week's low point, getting lower highs and lower lows. And this sideways trend that we were talking about that was setting up for a breakout type move, that was with the Keltner channels here. When you looked at the Keltner channel, so we were sizing up for a breakout move with the red dots. Well, there's your green dots. So we broke below the Keltner and the Bollinger Band. So there's our green dot with the breakdown that suggests we might be moving lower here for a while. So something, again, similar to this. Again, it won't take long before it happens. 350 is where that is. I think your worst case scenario is down into that area, this 318, 320 area. So it won't take long to get there. In fact, 350 is not very much of a move. It's less than 10%, a little bit more than 5% move just to get to 350. So we can get down to those levels really quickly. Then it's a matter of how long we end up staying and trending, bouncing up and down, but staying in that area down in this spot is where I expect we'll be by the time we get through the end of the summer here. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comments section below, especially if you disagree. What charts or indicators are you looking at that suggest that you expect it to be a lot more bearish than this, or that you're actually really a lot more bullish than I am right now? Share those charts with us down below in the comment section. All right, now let's take a look at the what's driving this action. Of course, obviously the biggest thing driving this action is inflation and inflation expectations. But you can see throughout most of this decline, commodities have been holding up really, really well. In fact, remember the decline really started year to date, and you can see commodities have really, really been holding up well, with bonds down pretty much as the Qs and IWM are both down, so as well as real estate, interestingly enough. So all these major asset classes down very significantly year to date, and the only thing that's up is commodities. And gold, people talked about, hey, it's not a very good inflation hedge if it's not doing very well. Well, it's killing all these other asset classes. You can't just look at it versus the dollar, because the dollar has got its own issue. Like it behaves on its own, right, compared to other currencies. So other currencies can impact, especially the euro, can impact what the dollar is doing. But it's really doing better than when gold is outpacing bonds, gold is outpacing real estate, gold is outpacing both ends of the large cap, small cap equity universe. So it's just outpacing everything, global bonds, corporate bonds. So to say that gold's not doing very well in this as an inflation hedge right now, with everything dropping as much as it is, the only thing it's not outpacing is commodities. But that's typical too in an inflationary environment. because those commodities will really outpace. And it's not outpacing the dollar either, but the dollar strength right now is very rare. It's very much an anomaly for this type, again, of this inflationary environment, and it continues just to really move on it. When you look at the dollar index, again, looking at it relative to a basket of currencies, it's basically achieved where it hit during the COVID move up to the upside, and it's gone parabolic here. The MACD itself has gone parabolic. It's about at similar levels here as what we saw back in the end of 2016. We ended up with a year plus of significant decline in the dollar after its MACD peaked here. Now in 2014 and going into 15, it continued, from what was a very high state. The MACD histogram peaked. We were still in convergence mode, and it continued up. But I don't know necessarily that we are in that type of environment again. I think we're more likely going to be in this type, where we're kind of getting a little bit of a divergence here with the MACD on the dollar. Again, it's mostly due to the euro and how the dollar is performing relative to the euro. In fact, if you look at the dollar's performance against this basket of currencies year to date, so we'll go currencies here, and then we'll go year to date on the dollar. It's actually underperforming the Mexican peso and outperforming the Canadian dollar, which are two of its larger trading partners. And it's, you can see where the euro is, and you can see where the yen. So these two make up 70% of the US dollar index, that futures contract, but not the trade weighted index. They don't make up nearly as big of a percentage of the trade weighted index. So the yen's weakness, not just against the dollar, but against everybody, is what's really pushing the dollar higher. The euro's weakness, not just against the dollar, but against these other commodity related currencies, is what's really helping keep it up, even if the euro year to date is outpacing the franc and the pound, two of its more closely tied trading partners. So you can see the European currencies are all down relative to not just the dollar, but again, other commodity based currencies. So it's not necessarily a dollar strength thing. It's a severe weakness in the yen, again, against everybody, and it's a severe weakness in these European currencies, again, against everybody. The franc and the yen typically are safe haven currencies, and the fact that they're down the most among the most during this decline kind of shows you about why the dollar is so strong. So the dollar strength is very atypical here during this inflationary environment. Usually that puts weakness on the dollar, and also kind of goes to show just how much longer we have for this dollar strength. With bonds, with the 2-year yield now in bonds doubling up, the 2-year yield for bonds right now is a higher 2 times the rate as the dividend yield is for the S&P 500. So it goes to show just how oversold bonds are and what a great long-term value they are right now. And the next day or two or next week or two, who knows if they'll go up or down, but from a long-term basis. And their downside is going to be limited by the fact that the yield spread right now is inverted. So long-term bonds downside will be limited. It doesn't mean they can't go down. It just means with the MACD above its moving average here, on the weekly chart, that it won't go down to the same pace as what we saw going into this decline. You can see again here, there's that TLT. So it's just been kind of flirting. Last week got above it, and this week so far below it, but very small, minimal moves. So we're in kind of convergence mode right now, and so your declines on this will be a lot. Will slow down with the yield curve inverted already. As much as it is. It just means that the Fed's probably going to raise rates. Basically, that yield curve being inverted tells you, usually it inverts when the Fed has raised rates. It's now inverted ahead of the Fed, which is not normal, but it's basically telling the Fed, the bond market's telling the Fed, this is where you need to be, and the Fed's finally catching up to that, right? So you have your 10-year and a 2-year right around this 3 1/3, so between 3 1/4 and 3.5%. And if you notice, that's where the Fed funds futures are now. You have about an 86% chance that's where we'll be by the end of the year. So, again, that's 250 basis points of rate hikes. 250, that's we have that's 250 divided by 5 is 50 basis points. So it's basically an average of 50 basis points from here on out throughout the end of the year that the market is priced in. Now, more than likely, that might mean we get, 75. That there's some chatter about 75 here in June, and then 75, 75, and then maybe another 25. But it's 50 basis points from here on out is what the futures market is saying. And combine that with what the bond market is saying, the yield curve says, okay, that's where they should be. That's where they would be if they weren't so far behind the curve, is what the bond market is saying. And the futures market is kind of giving us how long they will be behind the curve getting to that point. All right, let's take a look at how the sectors are performing here. Obviously, they're all down, and that was the big key, right? So when you look at the 12 grid, the key, the correction doesn't end until everything is dark pink shading and red line. And so far, you're not quite there. It won't be long till you get light pink shading on the energy. But obviously no red line yet. So everything has got to get. And right now, everything but energy is at light pink shading or dark pink shading and a red line. And you expect energy will get to that point too. So when I look at the comparison chart here, and you can see, like here, you can see it's catching up. But if I look year to date, this shows you just how far away XLE is to everything. So there's a lot, 50%, just to get to zero. I mean, there's a lot of room to catch up when all these cyclical areas are down 30% year to date, and real estate is down 25% year to date. Energy is up 50. So that kind of goes to show just how far down that can go before this correction is ended. And then everything bounces, right? Everything will bounce. There will be a low point. We will bounce. The question will be when we get our correction bounce, if it fails or not. We expect, you always expect that it won't. You expect that, corrections will bounce up to new highs like we've done 5 out of the last 6 times. But one of those 6 times was the 2007, 2008 correction at the beginning of 2008 that failed in May of 2008. And we ended up with the bear market by the end of that year. So that's the issue, right? So the odds are that we'll bounce up to new highs. The expectation is there's a lot of indications that this one, like that 2007, 2008 correction, will be the one that fails its bounce and produces a bear market by the time it's all said and done. You just remember, a bear market, I've been tweeting this out here, a bear market, like, TV says that this is a bear market and that wasn't. That's not the case, right? That is not the case. Bear markets, I tweeted out earlier today. Make sure you follow me on Twitter at DavidSettle42. I put a lot of stuff out there today. But there have been 4 bear markets since 1970, 4 of them. This is not one of them yet, at least. But let me see if I can find it. You can see I put out a lot of stuff today. Here we go. So here's the 4 bear markets, and I'll just retweet this, that we've had since 1970. This is what bear markets look like. Not 1987, not COVID, and not right now. And you can see them. This is on a log scale chart. You can see how they differ from these other 4 periods. These are the 4 bear markets that we've experienced since 1970. That goes back 50 years, more than 50 years. We've had 4 bear markets in 50 plus years. We had 2 kind of back to back, and we had those 2 kind of back to back. And it's kind of a double dip bear market, so to speak, even if they were 10 plus, 10 years apart or so. But this right now, so far, is not one. As you can easily visually tell, even if the media would like to say it is. All right, now let's take a look at Valero. This is our trade idea of the day, and you can see it's been strongly bullish for quite some time here during most of our correction on the S&P 500 since the beginning of the year. Valero has been on a bullish move. Dark green shading, a green line. You can see its weekly market forecast and looking very strong on a weekly chart too. Pretty much have been bullish since the end of. This is the daily. Let me get back to it. There we go. There's your bullish move since the beginning of the year. Really since late 2020, since the election of 2020, it's really taken off to the upside. We got a cluster at the beginning of the move, and potentially a cluster here near the end. Though you do notice we still haven't broken that 23% line yet. When you take a look at like the weekly chart here, We've been so bullish for so long, but you see we're getting a transition candle on this. When you look at the whole moving average for Valero today, big bearish candle, bigger candle than what we've seen, bigger drop than what we've seen here in quite some time. A red parabolic star flipping to the upside, but we don't have the red line yet on the hull. I'm going to venture to guess we get that tomorrow, and then we'll see, whether or not we end up breaking through the 200. Considering how bearish it's been, the bearish breakdown below its moving average down there on the PPO that we see. You can also see too on some of these other oscillators, big move on the, we were so extremely overbought, big change on the DMI. You look at the RSI and the CCI, they were so overbought, big change in the opposite direction. So we're getting a big retracement here. The trend strength indicator is still extremely high, and just to kind of give you an idea of how bullish that is, like this is the last time we were this bullish on the in 2018, early part of 2018. That's the last time this trend was this strongly bullish on the trend strength indicator, and you saw what happened there when we were that bullish. Looking at the Bollinger Bands, and let's look at the Keltner channels as well. On this, and go to Valero. Again, we were so strongly bullish, but now you can see with the green lines, the bands outside. But you notice that we are now moving back into the Keltner channel, into the out of the upper quartile into the middle point with this positive momentum, which has been bullish this entire time, starting to roll over. So. Getting some indications that we might be a little long in the tooth. Here's the weekly version of that chart. Let me go back to that 2018 time frame, that last time that we were so strongly bullish on VLO, and you can see what happened. It started off with that weakness right there, and that's what we're getting right now, even bigger momentum now. But you see we get the dark blue, which means the momentum is turning down here so far this week with that transition candle, you recall, on the weekly chart here. The weekly chart transition candle. So we're going to have an opportunity to move down towards some of these Fibonacci areas. Again, pretty much like the rest of the broader market has. If I were to go out here, just to kind of give you a sense, we are in the 90th percentile of how far away we are between the 10 and 40 week moving averages. Higher than we were in 2018, and about as high as we were in 2013. And you can see what happened there when we started to roll over. So needless to say, Valero's in a tight spot and potentially starting to move to the downside. So what we decided to do here was do a put spread going into July, going down not necessarily all the way to the low end of support, but going down to the 110, 115. You can see what that ends up doing is gives us a very small risk, about a 5-to-1 reward to risk ratio. My standard deviation sets us up for a little bit below 110, just that one standard deviation. Remember, we just barely started. I wouldn't expect if we drop sharply towards these moving averages, I wouldn't expect it to do it in one standard deviation move. That's usually a rally, not necessarily an upside. So I expect that we'll probably move down a little bit faster. So we'll keep our eyes on this one to see if we can get a good reward for a very, very small risk on this trade. Alright, well that does it for today. You've heard from me now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Subscribe to us at marketscholars.com for free. Like us on Twitter and Facebook. Have a great rest of your Monday night, everybody, and we'll see you all next time.